Hi friends, this is CA Fenil Shah, and today we have gathered here to discuss upon the very first case study of paper number 6 of CA Final. And with us, we are also having two other learned respected faculties, CA Palak Pavagadi sir, who will be discussing and dwelling upon the concepts of taxation, and also CA Maulin Kadikar sir, who will be dwelling upon the concepts of financial management. So friends, let me take an opportunity to first discuss in brief the whole scenario of this particular case one. Here, friends, there is one professional, chartered accountant named Mr. M, who has a very flourishing practice spanning in the areas of auditing, tax, and in tax, he is into both direct as well as indirect tax. And also, he is providing the consultancy, particularly in the laws of foreign exchange in Chennai. His clients include various HNIs apart from corporates and non-corporates. Now, one day what happens? One day, one HNI client, Mr. P, called him to inquire about the new rules pertaining to taxation or the emerging rules pertaining to taxation that is related to taxation on redemption of mutual fund investment. And he had heard a lot of things that the tax on the mutual fund has increased. He has also heard the news on some BTBC news channel, but was unable to comprehend it, to understand it in a very clear manner. And he, the client, Mr. P, was also not having clarity whether the changes have been made in the income tax law or in the rules framed by SEBI. Also, we can see in the third para that Raleigh Consultancy, an Association of Mutual Fund of India registered mutual fund distributor through mutual fund investments were made, was continuously forwarding messages received from MP to his mobile. These messages were at the best cryptic and required investors to be in touch with the chartered accountant or tax consultants. Now, friends, the Mr. P, who is a client of chartered accountant M, in the question, they've given the portfolio details of a chartered accountant, of Mr. P, who is a client. Mr. P had a very impressive investment portfolio of 50 crores in various mutual funds. And he wanted to know that any changes in income tax payout related to could affect the ROI adversely. Under the stress, he sought for an immediate appointment with chartered accountant M, and he went, and the summary of the mutual fund is like so. The first two mutual fund, that is MTL low duration fund of 10 crore and the Bond India low duration fund of 15 crore, both of these funds are debt fund. Of this particular both debt funds, it has been further clarified when you read in that the debt fund have invested 30% of their proceeds into equity shares of domestic and equity funds of domestic companies. Then when you see on the screen the third and the fourth, that is ABD New Energy Green Energy Fund of 15 crores and the fourth SBI Life Arbitrage Fund of 10 crores, then friends, this third and the fourth are the equity fund. And they've given that equity fund have invested 70% of their proceeds in equity shares of domestic company. Furthermore, they say that besides this, Mr. P, who is the client of chartered accountant M, has invested 5 lakh rupees in the liquid fund. And since amount invested was small, he was not bothered about the same. So friends, when we see this initial part of this particular case study, then the initial part talks about the relationship of chartered accountant M and Mr. P. Then the later part of the first talks about the portfolio of Mr. P, of which mutual funds he has and what category of mutual funds are there and what percentage of that proceeds of mutual fund are being invested by the mutual fund in the equity shares of domestic company. Further, they say that the investment pattern of funds is going to remain unchanged in the coming years too. And Mr. P was planning to redeem his portfolio tentatively on an average upon October 2023, obviously depending upon the market conditions which are prevailing at that point of time. Their discussion also weird, yani change the direction towards debt fund also. And debt fund invest mainly in government and high grade corporate bonds. And client was of the view that the interest rates in economy are likely to go up in few months, keeping in mind the broad macroeconomic indicators which are prevailing in the country. Then Mr. P also conveyed to chartered accountant that out of the proceeds which Mr. P is going to get by selling the mutual fund portfolio, Mr. P is going Mr. P is going to invest this by buying a villa in Goa. He is already 65 and wants to spend his quality time in the beauty city of Goa, and also he was ready to make an advance payment of 1 crore to the owner of villa. And very important, Mr. Christopher, who is the owner of Goa villa, is an Indian citizen and a non-resident Indian. This non-resident Indian, that is Mr. Christopher, who is the owner of villa, has acquired this villa as an ancestral property through registered will of his late father. And the total consideration to be paid to Christopher is 5 crore, including the 1 crore advance payment. So from this, friends, you can understand that now one more person has entered into the case, who is Mr. Christopher, who is an Indian citizen, but he is non-resident. He is the owner of villa, and how he got this villa? Then he got this as inheritance, right? And from his father, and his father was a resident in India. In fact, it is also one of the reasons for planned redemption of mutual fund investments in the current financial year. So Mr. P was of the view, that let me redeem my mutual fund investment, and the proceeds which I get out of it, I'll invest in buying the villa in Goa. So now he inquires from Mr. M regarding any precautions or legal requirements which are to be taken by Mr. P. Mr. P also discusses this matter with Christopher over the phone, who happens to be in India for a short time visit. And he in turn also inquires from Mr. Chartered Accountant regarding his investment avenues. Also in the case, they say that India does not have any DTAA agreement with the country of which Mr. Christopher is a resident. So they have not clarified that Mr. Christopher belongs to which country. Moreover, they also say lastly that Mr. Christopher plans to repatriate the proposed sales proceeds of villa which is located in Goa in India, in which he is resident, right? And he does not know the modalities or the legal formalities for the same, and also inquires with Mr. M that if Mr. M can guide upon this particular matter. So friends, when we try to look upon this case, and before I ask and open the forum for Maulin sir and Palak sir to answer along with me on the finance, on the FEMA, I would say that when you look upon this particular case study, three main persons are involved. One is Mr. P, who is the client of Chartered Accountant M, and what Mr. P is going to do, that whatever mutual fund investment Mr. P is having, he is going to sell that and is going to get the funds. So he is interested in knowing the tax perspective. And the funds which he get is he is going to invest for his better life, right? The life of the end. That is towards buying the villa in Goa, and he may live there. That is the point. So here we think we'll see the questions, but the questions may be from the perspective of two persons, that is Mr. P and Mr. Christopher, and both will be the clients of Chartered Accountant M. So when friends, you are reading this particular case study and the further the questions and the MCQs, you step into the shoes of Chartered Accountant M, and kind of you need to give guidance to two of your clients, one Mr. P and another is Christopher. So this is, friends, the brief of this particular case. And now let's move towards the discussion of, first we will discuss upon the MCQs which are there. Then let me tell you, there are 5 MCQs. The first 2 MCQs are with respect to finance. The third and the fourth MCQ is with respect to direct tax. And the last MCQ is with respect to FEMA. And then 3 descriptive questions are added to this case study. The 6th and the 7th descriptive question is with respect to tax laws. And the last descriptive question is with respect to Foreign Exchange Management Act, that is FEMA 1999. So in all, 8 questions, 5 MCQs and 3 descriptives is what this case study is made up of. So we had a brief discussion on this whole case study. Now let us first take the MCQ questions, and what I'll do is that I will ask the respective question to the learned faculty and they will answer the same so that you can have the idea of the whole concept. So as friends, we can see on the screen, the very first question dwell upon the concepts of financial management. So the first question is for Maulin sir here, that Mr. P has invested rupees 10 crores in SBA Life Arbitrage Fund. Which of the following statement is most appropriate about the arbitrage funds? The very first is, such funds tend to, I'll request you only to read the, you can say each and every option and you can just dwell upon it.
Sure, sir. Thank you.
Yeah.
Hello, dear students. The first question is, say, from the mutual fund concept. So let us read the question. Mr. P has invested 10 crore in SBA Life Arbitrage Fund. Which of the following statement is most appropriate for arbitrage funds? That is the first question. Dear students, I would like to read certain content with respect to the arbitrage funds which have been provided by the institute. It is on page number 8.11, on which the arbitrage funds information have been provided, say, in brief. Typically, these funds promise safety of the deposits, but better returns, tax benefits, and greater liquidity. Arbitrage का जो simple concept हम लोग समझते हैं, let's say you take advantage of certain mispricing in the market. That is what we understand is the arbitrage opportunity. और कुछ funds ऐसे हैं कि जो ये opportunity को grab करते हैं, and that is what we understand is the arbitrage funds. उसका रिटर्न इक्विटी के जैसा फैंटास्टिक ऑफ कोर्स नहीं होगा, बट एट द सेम टाइम से जो रूटीन डेट फंड्स है उसकी कंपैरिजन में वो रिटर्न ज्यादा देंगे. इन दैट वी अंडरस्टैंड इट्स ए नंबर ऑफ ट्रेड्स टेक प्लेस, परचेस एंड सेल. दैट इज द रीजन सर एक्सपेंस रेशियो उसका कंपैरेटिवली ज्यादा रहेगा. द ओपन एंडेड इक्विटी स्कीम एम्स टू जनरेट अ लो वॉलेटिलिटी रिटर्न्स बाय इन्वेस्टिंग इन द मिक्स ऑफ cash equities, equity derivative, and debt market. The fund seeks to provide better returns than typical debt funds. यानी यहाँ पे ये लोग arbitrage funds का बात कर रहे हैं. This fund is say generating a better return than a normal debt funds and lower volatility in comparison to equity. Of course, उसका volatility है, उसका risk है वो comparatively कम रहेगा. Arbitrage fund seeks to capitalize on the price differential between the spot and futures market, and at the same time, so between the two markets at one point of time, the price differences can be there. तो यहाँ पे क्वेश्चन में हमको ये पूछा है, which of the following statement is most appropriate about arbitrage funds? Such funds tend to provide better returns than equity. देखो यहीं पे ये स्टेटमेंट गलत हो जाता है. In no case it is going to beat equity. B, such funds provide better return than debt instrument. Correct. However, they have higher volatility in comparison to equity. यहाँ पे ये statement गलत हो गया. उसका volatility equity के से ज्यादा बिल्कुल नहीं होता. Equity में ज्यादा risk और ज्यादा return का potential. Such funds यानी arbitrage funds tend to provide better return than debt instrument. सही बात है. However, they have lower volatility than equity. ये भी सही बात है. They seek to capitalize on the price difference between the spot and future. This is also what we have read recently. Expense ratios in the arbitrage funds are higher in compared to liquid funds. ये भी सही है. So the C is the correct answer, friends. Last वाला पढ़ लेते हैं एक बार. Such funds tend to provide better return than equity. यहीं पे ये statement गलत हो जाता है. In no case, so it can beat the equity market. I'm reading the second question, dear students. Second question is a very, very, very general question. It is not at all related only to the mutual fund, or it is absolutely a very general question that they have provided, friends. Mr. P is of the view that the interest rate in the economy are likely to rise. Means the capitalization rate for the investor is likely to go up. What likely impact would it have on the NAV of the debt fund? बहुत ही आसान है. अगर investor का required rate of return बढ़ेगा, then in that case the price of the debt fund is going to fall down. यहाँ पे दे रखा है ignore other factors like duration of the bond. अगर उसको consider करेंगे ना तो भी वही आंसर आएगा. This is what they have provided. However, उसको consider करेंगे ना friends तो भी वही आंसर आएगा. It is likely to lead to fall in the NAV of the debt funds. A is the correct answer. बाकी का पढ़ लेते हैं एक बार. It is likely to rise. Rise is wrong. क्यों? क्योंकि अगर required rate of return बढ़ेगा, then the price of the existing securities will definitely fall down. Next, likely to remain same at the past level. That is wrong. It is going to fall down. That is the reason. Is not affected by the movement. It is absolutely wrong. It is affected by the change in the market scenario, change in the required rate of return. Thank you very much, all of you. Handing over to Fenil sir. Fenil sir, thank you very much.
Thank you, sir, for dwelling upon both the questions or both the MCQs, the initial two, which were with respect to your subject. So now, friends, when we see the third MCQ, then third MCQ wise, the third and the fourth MCQ is with respect to taxation subject. And the last fifth MCQ is with the subject of economic law, that is Foreign Exchange Management Act. So now let me just do the screen sharing and then would request Palak sir to deal upon the two MCQs, the MCQ number 3rd and MCQ number 4th. Just a minute. Yes, Palak sir.
Hi, dear students. Thank you. Thank you, Fenil sir.
Yes.
This is the client, Mr. P, going to the office of the chartered accountant and asking for the advice from the viewpoint of taxation also. If you read the third question, it goes this way. As regards the proposed purchase of villa in Goa from Mr. Christopher, who is a non-resident. It is written in the question that he is non-resident, is concerned. Which of the following statement is likely to be correct as regards deduction of tax at source is concerned? Assume it does not have any other taxable income in India except capital gain from proposed sale of villa. Ignore surcharge and the sales. The question is, the client Mr. P is buying the property from a non-resident Mr. Christopher against the sale of the mutual fund. Now, when Mr. P buys the property from the non-resident for the purpose of making the investment, which of the provision for TDS will hold good for Mr. P? Option A says, Mr. P is required to obtain 10. TDS is required to be deducted only at the rate of 1% on 5 crore. Entire TDS can be deducted at the time of or before registration of the title deeds. Friends, here, all the three things which is written in option A is not correct. Number one, they are talking about the TDS at the rate of 1%. 1% rate is applicable under section 194IA, which applies when we buy the property from the resident. Here, Mr. Christopher is non-resident, so that 194IA and 1% will not come. Had this been 194IA, requirement of TAN number is not there. And the third, entire TDS can be deducted at the time of or before registration of the title deed, which is also not correct. General rule in the TDS is it is made on payment or credit, whichever is earlier. So first, ruled out. The second, it is not mandatory for Mr. P to obtain the TAN number. TDS is mandatorily required to be deducted at the rate of 20% on 5 crore. However, TDS would be deducted at the time of making advance payment as well as at the time of making balance payment. Here, they are giving two correct options. Option 1, 20% on 5 crore, because the TDS is required to be made under Section 195, and Section 195 says TDS is made on the gross amount, and that gross amount rate of TDS would be the rate which is applicable in the case of the long-term capital gain, which is 20%, ignoring surcharge and cess. And the TDS is required to be made on payment or credit, earlier of the two. So they are saying this too correctly. But the unfortunate part, it is not mandatory for Mr. P to obtain the 10. In 195 TDS, it would be mandatory for Mr. P to obtain the 10 number. So that second, because of this first sentence is not correct. The third one, it is not mandatory for Mr. P to obtain the 10. Application can be made to the learned assessing officer for determining the capital gain on which tax is required to be deducted. In that case, see, this particular statement, application and all other things, very nice. But as I have said in point B, it is not mandatory for Mr. P to obtain the 10 number, makes this particular statement also very incorrect, sir. And the fourth one, if we can see, the fourth point D says that, sir, if you can scroll the screen, please. Well, sir. Point D says, Mr. P is required to obtain TAN as far as 195 is concerned. TAN number is compulsory. An application can be made to AO for determining the capital gain on which tax is required to be deducted. In that case, TDS would be deducted at lower rate after determining the capital gain by the AO in the international wing. If lower deduction certificate is not available, TDS would be deducted at the rate of 20% on 5 crore. However, TDS would be deducted at the time of making the advance payment as well as at the time of making the balance payment, meaning thereby TAN number compulsory, rate of TDS will be 20% unless otherwise we obtain a lower TDS certificate. And third, TDS is required to be made on payment or credit, whichever is earlier. So advance payment on that part and the balance payment on that part, the TDS is required to be made. So correct answer, my dear friends, is point number D, which is in all respect totally correct. So that is the third one in regard to the TDS. The fourth one, as regards Mr. Christopher's inquiry regarding purchase of another property. See here, Mr. P is very kind, asking the question not from his viewpoint, but as well as from the viewpoint of the non-resident seller to him. As regards Mr. Christopher's inquiry regarding purchase of another residential property in India and investment in bonds of NHAI and filing income tax return, which of the following is most appropriate? Ignore issue of refund arising on account of TDS for return filing. Number one, non-resident can make above investment to save capital gain tax. Yes, there is no prohibition in 54. There is no prohibition in 54 EC. 54 talks about selling long-term residence and buying the new residence, and 54 EC talks about the specified bonds. They both are available to the non-resident. So the first sentence is correct. However, after making investment, if he has no taxable income, there is no legal obligation to file the return. 139(1) is amended a few years back. Few years back, the amendment says that if the total income of the assessee before allowing general deduction, before exemption under Section 10A, 10B, and the most important, before exemption under Section 54 and the subsection of 54 exceeds the basic exemption limit, it would be obligatory for the assessee to file the return. So if he has no taxable income, there is no legal obligation to file the income tax return, makes the statement wrong. Second one, B, non-resident can make above said investment to save capital gain tax, perfectly correct. However, if his total income before giving effect to deduction against such investment exceeds basic exemption limit, there is legal obligation to file the return. This seems to be perfectly correct. So B, let us keep it as an option. Friends, number of times it so happened that institute is giving two similar correct answers. So I would advise you to check C also. NR cannot make above investment, makes the statement wrong. So ruled out C. D, non-resident can make investment by purchase of another residential property, but cannot make investment in the bonds of NHAI. D is also ruled out. So here, the answer B is the correct answer, that they can make both the investment, they can enjoy the exemption. Filing the return is compulsory if the income exceeds basic exemption limit before the exemption. So these are the two MCQs, panel sir, from my side. Over to you, sir.
Yes, sir. Thank you, sir. So friends, after seeing the first two MCQs from finance perspective and then having a deep dive into the next two MCQs from text perspective. Now, friends, when we try to look upon the last MCQ, and then friends, we'll move towards the descriptive questions. Now, friends, as the case goes, that Mr. P is buying the property from Mr. Christopher, who is a non-resident Indian. Right. So Christopher is going to get the sale proceeds in India of his villa, which is located in Goa. Now, Christopher is willing to repatriate these funds to his own country. Right. So now here the question or the MCQ revolves around the liberalized remittance scheme. So now before we move towards the MCQ, let me just give you a brief of what LRS is. Then whenever any non-resident Indian or whenever any person who is resident in India wants to deal in foreign exchange in India, then the transactions are bifurcated into two types. One is capital account transaction and another is current account transaction. Now, when the transaction is with respect to property sale, obviously you can very well understand that it is with respect to capital account transaction. Now, when you see the capital account transaction restrictions, then certain government approvals are needed. But if you try to cover yourself into the LRS, that is a liberalized remittance scheme, then up to certain limit, if you are doing a transaction, you are not required to obtain the government permission. So the question revolves around the same. And what is the provision with respect to liberalized remittance scheme? Then you can say that under the LRS that is issued by RBI, Indian residents can remit up to 250,000 US dollars per financial year. And this encompasses or this covers all form of overseas transfer. Then maybe you make for any kind of gift, or maybe you make for any type of investment, or you make for any type of property purchases. So all the transfers clubbed together, the ceiling limit is of 250,000 USD per financial year. And this is available to Indian resident. Now, with this base in mind, let us look upon the fifth and the last MCQ of this case study 1. It talks with respect to that Mr. Christopher, who is an NRI, who sold his property to Mr. P, let us say, right? It's planning phase going on. And he's getting the funds from Mr. P. Plans to repatriate the said funds from India to his own country of citizenship. Now, which of the following statement is most appropriate in this regard? Looking at the very first MCQ, proceeds up to USD 250,000 can be repatriated in a financial year by using LRS, as it is a capital account transaction falling under the scheme. Now, ऊपर से आप देखो तो it seems that this is a correct MCQ, correct option. Let us also see few more. Option number B. Proceeds up to USD 250,000 can be repatriated in a calendar year. Oh, here is a glitch. LRS scheme is not based on calendar year. LRS scheme is based on financial year. Right? So option B is wrong. The third option, option number C, the proceeds can be repatriated using the NRO account subject to certain restrictions in a financial year. Now, friends, we know that if there is some non-resident Indian in India and he wants to repatriate or he wants to manage his funds, then he has two options. One is the NRE, that is non-resident external account, and another is the NRO, that is non-resident ordinary account. And non-resident ordinary account allows to receive fund or repatriate fund in INR or in foreign exchange. So this is also one of the option available. And first we also see the last one, that is D. Proceeds up to 2 lakh 50. Okay, proceeds up to 2 lakh. Then this is wrong, because scheme allows a cap of 250,000. Now, from all this four, which is the correct one? Then friends, here the point is, जब आप लोग ये MCQ के ऑप्शंस पढ़ रहे हो तो ज्यादातर आपका ध्यान 250,000 USD वो कैप पे जाएगा, कुछ स्टूडेंट्स का ध्यान जाएगा कैलेंडर ईयर है कि फाइनेंशियल ईयर है. But friends, let me try to bring to your notice here a very important point, that friends, जब हम क्रिस्टोफर के एंगल से सोचते हैं, who is a non-resident Indian, then friends, let me try to bring to your notice that LRS is available only for resident individuals. And Christopher being NRI, this LRS scheme is not applicable to him. So friends, here three options are outrightly striked off: option A, option B, and option D. And the C option remains correct and tenable. That is, he will repatriate using the NRO account and subject to restrictions in a financial year. And let me just bring to your notice that subject to all the certain restrictions and relevant circulars and relevant regulations, the limit presently till now is 1 million USD per financial year. So friends, from the four options, the option number C is the correct one. And this MCQ was based on the liberalized remittance scheme of Foreign Exchange Management Act 1999. So friends, hereby we can say that of your first case study of ICA, the first 5 MCQs are done up with. Now friends, the next we have 3 descriptive questions. And in that 3 descriptive questions, when we will move ahead, you will see to it that the first 2 questions, that is question number 6 and question number 7, are from the income tax subject. And the last again is with respect to FEMA. So now I would again request Palak Pavagadi sir to take upon the 6th and the 7th descriptive question, and then again I'll dwell upon the last FEMA related question.
Thank you, sir.
Yes.
Dear students, descriptive question number 1, that is question number 6 of the particular case study, goes this way. Since Mr. P wants to redeem his entire portfolio in the month of October 2023, what should be the advice of a chartered accountant to him regarding income tax implication on such redemption? Do not calculate income tax and tax liability. We are not here to make the calculation. Here we are here to give the advice. Just describe the manner of taxation and the rates. Ignore surcharges. What further advice he should offer regarding news heard on TV and messages received on the mobile? Friends, it's some new schools which are run by the social media. So our institute is asking that whether we should follow or not. I'm not saying don't follow, but follow if it is following the right provision. Sir, if we check out with the portfolio of Mr. P, sir, if you can scroll the same to the question, please. Our portfolio of Mr. P consists of 4 different types of mutual funds. Those mutual funds are of around 50 crore rupees. Sir, please, yes. Number 1, MTV Low Duration Fund, Born India Low Duration Fund, ABD New Green Energy Fund, and SBI Life Arbitrage Fund. Now, if we check out, these 2 funds are date fund. And sir, if you can go slightly down.
Yeah, yes, sir.
Down, please. Please. Okay, this is okay. Slightly up. I want this first, second, third, fourth table and the first line. That's it. Okay, fine.
I just zoom out a bit.
Yeah, it goes this way. So he also informed CA Mr. M that funds stated in 1 and 2 are date and funds stated in 3 and 4 are equity fund. Now the provision related to date fund and equity fund, if we check out, date fund would be considered as long term if it is held for more than 36 months. Equity fund would be considered as long term if they are held for more than 12 months. Another very important point over here is both the date funds are said to be held by my assessee from 2020. He wants to redeem this in the month of October 2020. So April 3rd, 2020, 10 crore MTV low duration fund will become long term, while 12th December 2020, that 15 crore Born India low duration fund will become short term. And the rule for long term will be, you will get all the benefits, including the indexation, and it would be taxable at 20%, while Born India low duration fund, simple sales price and cost price difference will be chargeable at the normal rate applicable to the non-resident assessee. So this covers these 2 funds, which are, friends, date fund. Another very important point they have mentioned is that he further informs that these date funds have invested 30% of their proceeds in equity shares of domestic company and equity funds have invested 70%. Now the rule under section 50 into bracket 50 double A, double capital A brought in says that if less than 35% proceed is invested in the equity market, then even if you hold this particular fund for more than 36 months, the rules of short term will be applicable to such type of specified fund. But I would be making one point very clear, my dear students, that this provision has been brought in saying that it would be applicable only if these funds are acquired on or after 1/4/2023. Here the funds are acquired in 2020. So the old provision will be applicable. All this social media, all this news, all these messages related to the change in the provision 50AA is no more applicable for these two funds which are redeemed in the year 2023. Had this been purchased on or after 1/4/23 and redeemed thereafter, whether within 36 or after 36, the new provision 50AA normal rate short-term capital gain would have been applicable. But in our case, first one will become long-term and the second one will become short-term. The third fund and the fourth fund both are said to be your equity oriented. 2nd December 22 makes the fund short-term, while 8th November 21 makes the fund long-term. I'll be clear that if it is 8th November 2021 wala SBA Life Arbitrage Fund, rupees 10 crore investment, sales proceeds less 10 crore will be without indexation, will be taxable under section 112A at a flat rate of 10% on an amount exceeding 1 lakh rupee. So here you will get that benefit of 1 lakh not taxable and balance will be taxable at a concessional rate of 10%, while ABD New Green Energy Fund being short-term, sales price and the cost price difference will be taxable at 15% under section 111A of the Income Tax Act. So this is the answer to the first descriptive question. So we can go to the next question, please. Point 7 says, Mr. B has also planned to invest further 10 crore in MTL low duration fund and One India low duration fund taken together in financial year 23-24. What are the tax implications on redemption of above investment after holding it for more than 3 years down the line? Sir, I am very clear in saying that if this date fund, not date fund, I would be clear, specified fund. What is specified fund? The fund do not invest in equity more than 35%. Then they are called specified fund. They are covered by section 50AA. If they are acquired on or after 1/4/2023, always the difference between sales price and the cost price will be taxable without indexation, and concessional rate benefit of 20% is also not available. It would be taxable at a normal rate. So those who are making investment in the funds wherein the fund is investing less than 35% in the equity, there is a red flag given by the government. You will not be getting the benefit of the concessional rate of tax, that is maybe 10%, maybe 20%. That is otherwise also not available in the case of the date fund, but you cannot get the benefit of indexation and you cannot get the benefit of concessional 20. It would be considered as only actual cost deductible, and the rate of tax applicable to would be the normal rate of tax. So dear students, these are the issues mainly based on the subject TDS and the capital gain. Thank you. Thank you very much, sir.
Thank you, sir. So now you can say that after the discussion by Palak sir on the 2 descriptive questions related to tax, now we move towards the last question, which is with respect to the Foreign Exchange Management Act again. Now, friends, the thing is, the Mr. Christopher, who is a non-resident, is planning to sell his villa in Goa. Now, examine the validity of this transaction with respect to FEMA 1999. Now, Now we can say that friends, that here this is a much open-ended question. Now, first is Mr. Christopher is a non-resident Indian. And second, he is planning to sell his villa. So here, friends, section 6, which talks about the transactions, is applicable. And in that too, section 6 talks with respect to capital account transaction is applicable. And in that also, subsection 5, which talks about the transactions which are done by non-resident Indian or person resident outside India is applicable. Now, friends, that says that whenever any PROI, that is person resident outside India, can buy, can hold, or can transfer what? Indian currency, can transact into securities or into immovable properties in India. So that can be done by person resident outside India. And also the PROI who has acquired the INR or securities or immovable properties when he was PRI, or when it was, or he has inherited it from PRI, person resident in India, then in that case, it will not be the issue. So this, that is section 6, subsection 5, will be the provision which will validate the legality of this particular transaction which is going to happen here. So also the solution gives the same answer if we try to look upon it. You can see here on the screen, friends. As I said, section 6, subsection 5 of the FEMA validates the transaction. And they say that a person resident outside India may hold, own, or transfer or invest in Indian currency or Indian security or any immovable property situated in India. Now, very important, if such currency, security, or property was acquired, held, or owned by such person resident outside India when he was PRI, or he inherited from a person who was PRI. Now, friends, when you look at our given case, then the villa which is situated in Goa was an ancestral property, and Christopher obtained the same by a registered will of his father, and his father was Indian resident. And that's why the sale of villa by a non-resident owner is absolutely a valid transaction. So, friends, we can say that hereby we come to the end of the discussion of the first case study. And I would like to thank the Navkar Digital Institute and also the co-faculties, that is CA Palak Pavagadi sir and CA Maulin Kadikar sir, for spending their time and discussing for the students' advantage this particular case study in very much of depth. So now, friends, again, we'll meet for the another case study in the times to come. Thank you.